I'm Cynthia Rowland, and this is episode 159 of EO Radio Show. This is the second of 3 episodes focusing on gift acceptance policies for public charities. In episode 158, I went through an introduction as to why gift acceptance policies matter, what the best ones cover, some governing principles, and some guidance on who should make the decisions at each step of the gift acceptance process. In this episode, we'll talk about a spectrum of gifts and the diligence that applies to each of them. The asset types that are offered to charity range from the easiest, that is outright gifts of cash, no restrictions, one lump sum, and some get much harder. Some, like real estate, require a great deal of diligence. Gifts that include complex restrictions and reporting requirements are also very time-consuming to implement. We'll have a little deeper dive into certain kinds of gifts and some planned giving vehicles. In the next episode, we'll cover IRS compliance requirements, donor recognition, and I'll cover implementation of gifts that are subject to significant restrictions. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. Today, we're going to put the gift acceptance policy framework to work across actual asset types and focus on when and whether particular kinds of complex gifts are appropriate for your organization so that you can craft your gift acceptance policy to meet the needs of the organization and its staff and its donors and its charitable class that's served. All of those constituencies need to be attended to in crafting a gift acceptance policy so that the overall gift development process actually promotes the organization rather than causing donor friction, financial or other risks to face the organization, or end up just consuming an inordinate amount of time that diverts from the organization's mission. The basic concept for most organizations is that their gift acceptance policy is looking for gifts that can be converted to cash, that can be liquidated so that the budget of the organization can be met. Now, obviously, sometimes gifts are made of complex assets that actually support the organization's mission, and that's fine. It's just a different lens that the development staff needs to look at. So let's talk about the spectrum of assets that most organizations want to think about as potential gifts that they would like to receive. So let's start from the easiest, gifts of cash. An organization is well served by having the ability to accept cash in any form, checks, wire transfer, ACH, credit card, whatever it takes to provide the lowest friction avenues for donors to make gifts. There is plenty of work to do in that regard, though, and sometimes the gift acceptance policy wants to spell out the types of intermediary organizations that the charity will accept gifts through. Plenty of fundraising platforms and platform charities out there that raise money for other organizations. That's a topic for a whole other episode, but it is an important point for the gift acceptance policy as to which organizations the specific charity wants to work with and how it wants to set up all of its mechanisms for accepting gifts of cash. It's also very common for organizations with a robust fundraising program to have mechanisms to receive gifts of publicly traded securities. This does generally require a trading account at a brokerage house so that the securities can be transferred directly. But other than that, there's usually not a whole lot of diligence. The standing instruction is that publicly traded securities are liquidated on receipt. For some organizations, there are securities law restrictions that you'll need to attend to if the donor is a key person that's subject to securities laws for the particular gift they want to make. But the donor will usually be alert to that, and development staff should be basically fluent in the fact that securities laws will need to be looked at. Although they don't need to understand all the laws, it is important to flag that. So a well-crafted gift acceptance policy will address those sorts of questions for a gift of publicly traded securities. Next level of difficulty, and this is often a very big leap from cash and publicly traded securities, is when a charity is offered a gift of closely held securities in a closely held business that is not publicly traded. These can be gifts of corporate stock, limited liability company interests, and sometimes limited partnership interests. And your policy should require that competent legal advice must be obtained before accepting these sorts of securities. Whether that's an in-house counsel or outside counsel, it should be someone other than just the donor's counsel. It's really important to review any transfer restrictions that apply to the stock, whether the stock is marketable, if the stock or the interest is retained for any significant amount of time, whether there will be income tax consequences from unrelated business taxable income. And that's not usually a problem with corporate interests, but it is almost always an issue for limited liability company or limited partnership interests. It's almost never in the charity's best interest to hold interest in an operating business that's not a publicly traded security. It's a highly complex asset and probably deserves an episode of its own. But for now, the main takeaway for your gift acceptance policy is to decide as an organization whether you categorically will or will not accept gifts of complex business interests. And that can short circuit a great deal of staff due diligence if it's really not something that the organization wants to take on. Sometimes these complex gifts are initiated by board members or other major donors to the organization on the eve of a liquidity event. And so sometimes it is very, very tempting, but it does carry a great deal of upfront investigation and diligence for the organization. And so the gift acceptance policy should spell out in some detail what the organization's expectations are for that kind of a gift. Another complex area is gifts of tangible personal property. Sometimes things like used car programs become part of a fund development strategy. Sometimes they're gifts of artwork, things like that. So these can be appropriate gifts, but again, it all depends. And so the gift acceptance policy will either need to categorically provide that as a policy matter, it will not accept tangible personal property. The board can always make an exception if there is a major donor or a major gift that does make sense. But if the organization does want to consider tangible personal property, it's really important that the policy requires staff to confirm the marketability of the asset and how it would be marketed before accepting the gift. They'd want to be sure that there aren't any attendant sale restrictions imposed by the donor. And you want to understand whether there are significant carrying costs, such as insurance in the case of artwork. All of those things can cause the organization to decide accepting the gift is more trouble or more expense than it is worth. Things like car, art, and jewelry also have special tax deduction rules. So you'll want to be sure that the donor has consulted with his or her own counsel before you spend significant charity resources on determining whether you would take the gift and if so, how you would market it. While big ticket items may not come up very often, it's important to note that gifts of personal property that are offered for fundraising auctions should also be assessed carefully to make sure that the donor understands the benefit of the charitable contribution deduction that they'll receive, if any, when they're making a gift of personal property for a fundraising auction. Next category of gift is retirement plans and life insurance. While it's generally encouraged, most organizations do want to encourage their donors to designate the charity as a beneficiary. That's fairly simple and straightforward. If a donor offers a life insurance policy that has ongoing premium requirements, that should be a red flag for significant diligence. Another category that used to be quite popular, I don't see it as often anymore in my practice, and that's gifts of oil, gas, and mineral interests. These are important to accept only selectively. There's a lot to consider in taking those sorts of gifts. So while most gift acceptance policies will touch on it, as an organizational matter, you may want to say, no, we're just not going to do that. Then finally, kind of the opposite end of the spectrum of oil, gas, and mineral interests, which are very much old school. The newest category are crypto and digital asset contributions. These are very important to consider on a case-by-case basis, and usually the charity will want to work through a third-party custodian. It will accept the crypto gift and then liquidate promptly and provide to your charity only the cash that results from the sale. One final thought on digital assets that may be offered. It's important that the policy reminds staff to flag for the donor that there are potential tax traps. Digital assets are not publicly traded securities for charitable contribution purposes. So a qualified appraisal is required anytime the claimed value of the cryptocurrency exceeds $5,000. And obtaining an appraisal is often an expensive and somewhat time-consuming project. It's not really the charity's problem, but the donor's expectations need to be managed appropriately. The rules are really complicated when you're talking about gifts for anything other than cash or marketable securities. Generally, assets other than cash are deductible at fair market value only if the donor has held the asset for more than 1 year. Be sure that if a donor is expecting tax benefits, that they have worked out the details with their accountant and lawyer. We'll unpack the appraisal and reporting mechanics more fully in part 3 in this series. So let's go back to the real estate transaction and what the gift acceptance policy needs to highlight for those sorts of gifts. So no real estate asset should be accepted until and unless significant diligence is done by the organization in advance. Someone from the organization, either a staff member or a qualified agent, needs to physically inspect the property. And this inspection should be done by someone with experience in the particular property type. If it's residential rental real estate, you need someone who's experienced in managing those kinds of properties. Almost always a professional property inspector will be needed for developed property, whatever kind of structures are built on it. Sometimes some organizations that have strong development programs and often take gifts of real estate will have sophisticated staff members or board members who can do the review. But if not, it's worth every penny to engage an outside expert to do an impartial review of the property to highlight all of its flaws and its benefits. And all real estate has issues that come with it. It just is par for the course. Next, for almost all real estate, you'll need environmental review. Almost always, at least a phase 1 environmental analysis should be obtained from a qualified inspector. Even unimproved land needs an environmental review. That doesn't mean that the gift needs to be declined if the phase 1 analysis uncovers any environmental risks. But the organization needs to understand what those risks are and have them analyzed by a sophisticated counsel that can assist the organization in deciding whether that environmental issue is going to be a significant barrier to converting the real estate to cash. The next, if you've gotten through the inspection and the environmental review and the gift still looks good, the next thing to think about in diligence is the expectations of the organization in terms of the donors' representations, warranties, and potential indemnity for any financial liabilities that come with the property. Part and parcel of the protecting the organization is to make sure that an appropriate title search has been done and that the organization can obtain title insurance so that they actually have to sell and convert to cash what they think they're receiving. Next part of the diligence on real estate is carrying costs. How long will it take to sell this real estate and convert it to cash? And in that time period, what is going to be the cash flow required to hold that property until it's sold? Typically, that's things like insurance, property taxes, maybe even the cost of a caretaker to keep the property safe while it's being marketed. If it's an operating rental real estate, piece of rental real estate, who's going to manage the tenants? All of those things need to be thought through and should be called out in the gift acceptance policy as part of the diligence. A final point here in the diligence, is there a loan on the property? Sometimes it is fine to accept a gift of real property and assume the loan, but that's going to add complexity to the donor's charitable contribution. And so it's always important to get outside counsel on the effect of an assumed loan on the gift. Now, sometimes that's a great thing to do if it's a bequest and the decedent gave a piece of property to the charity and it has a loan on it and it's security for a loan. It's not a non-starter, but it is very important to get outside professional advice on how the organization will need to treat that property and any income from it. There may also be unrelated business income tax risk. Again, even if there is unrelated business income tax, sometimes 70 cents on the dollar is better than no cents on the dollar. So what if you pay taxes? Sometimes that's fine. But the organization needs to understand that and have the liquidity to cover the potential income tax while you're waiting to sell the property. I just want to touch briefly on planned giving vehicles. Most gift acceptance policies also have a section on whether the organization will accept planned gifts such as charitable remainder and charitable lead trust gifts. And also sometimes the organization the development office engages in sophisticated discussion with donors about their estate plans, pledges, and other ways that they plan a gift over a series of years or at death to the organization. Now, we cover charitable remainder and charitable lead trust strategies in several other episodes, and I'll link to those in the show notes. Tying this back to the gift acceptance policy itself, for many organizations, the development staff is not going to get into significant planned giving conversations beyond just gifts that are made over a number of years that are pledges and are not intended to be part of the donor's estate plan. And that's fine, but be sure to tailor your plan to what's feasible and reasonable in your charity's circumstances. So, closing out this session, every one of these asset types brings us back to a basic discussion of how liquid is the gift, what will it cost to get it there, and who's going to approve the terms of the gift and whether it makes sense for our organization. The gift acceptance policy should be clear on all of those points for each type of asset. In the next episode, we'll cover what to think about in the gift acceptance policies for the stage after the gift has been accepted. What does the IRS require? How do you recognize and steward those IRS requirements through the process? And how does the organization actually implement and maintain its gift acceptance policy? So with that, we'll wrap up this session. Be sure to check the show notes for additional resources on these topics. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.